This episode is brought to you by TradeZero and Lupton Capital.
Hey, everybody. This is Jonah Lupton from Investing with the Whales podcast. Very excited today. This is the relaunch of the podcast under a new name. And our first guest today for the podcast is going to be Jared Isaacman, co-founder or founder and CEO of Shift4. Now, first off, Jared, for a lot of people that don't know the Shift4 name, you started this company back in the mid-90s when you were 16 years old in your parents' basement. So just take us back and maybe you can kind of give us a recap of the last 25 years of this company and the different iterations and acquisitions along the way.
Yeah, it sounds good. So it all started with me hating high school. So I have older brothers and sisters, 15 years, 12 years, and 8 years older than me. So while I was in high school, kind of having to raise my hand to ask permission to go to the bathroom, they were out, either out of college and already kind of living their lives and, very independent. And I like that. So I was like, I got to get out of here. I was working for a payments company called MSI. And at that point in time, there's no magic here. I mean, it was all just about enablement. There were still a lot of businesses that were just cash only from a payments acceptance perspective. So it wasn't hard. You just had to kind of reach out and get them set up. But a lot of things around that process were just terrible. Like if you were a pizza joint and you wanted to accept credit cards from your customers, the paperwork process was like getting a commercial mortgage. It was kind of ridiculous. So anyway, I was working there long enough to see some of the opportunities and I left. And then kind of started what would ultimately become Shift4 in my parents' basement. So 16 years old. And in the beginning, it was just all about operational efficiencies. Like, how do we just make this experience less painful? Because everybody else is so focused on card issuing, like giving as many consumers credit cards to get overextended as possible. And no one's kind of really thinking through the other side of the equation, which is how do you make this a little bit more pleasant on the businesses that want to accept credit cards as a form of payment. So that was kind of our start. We wound up growing really quickly. After a few years, when pretty much every business that wanted to accept credit cards was capable of doing so, I was like, we gotta figure out what the next evolution here is, or else prices are just going to get just going to tank. The industry will just be commoditized. So we wound up looking at parallel industries, which was software and hardware. And we were like, if you can bring together kind of commerce enabling software, like those touchscreen point of sale systems, and kind of, consolidate these industries so that they're no longer operating in parallel, but vertically integrating, hardware, software plus payments to do a nice experience, stop selling hardware. Let's just go towards more of a SaaS and payments model. We probably can be pretty disruptive. And we were. So for the next 10 years, we were just growing like crazy.
When you first started the company, it was United Bank Card.
Right.
And the hardware you're talking about was the launch of Harbor Touch, right?
Perfect. You can even think about at 16 years old and you're trying to come up with a company name that seems like you're established in, traditional banking and services. You come up with a name like United Bank Card. And then when you realize about 5 years after we started, and we still had plenty of tons of growth those first 5 years, that, we're going to be moving into a much more, tech direction where we're going to bundle software and hardware and payments together. We need, a much sexier name. And we created Harbor Touch. And ran with that hard for 10 years in the restaurant vertical. So much so that eventually, after 14 years in business, finally took on outside capital and said, there's a real M&A strategy here to kind of consolidate what was a fragmented restaurant technology industry. So went out and acquired 3 other companies, and we went overnight from essentially serving just the Irish pub on the corner to the Blooming Brands, Cheesecake Factories, the entire swim lane of restaurant payment technology. And then, from there, we went into hotels. We now have about 40% share of the hospitality market, half the Las Vegas Strip, pretty much every, ski resort in the country. We moved into sports and entertainment stadiums. What you'll find, though, is a common theme across all these verticals is it's our payment platform connecting into commerce enabling software. Like the days of the brick terminal that just spit out a receipt of approval or decline, they're over. It's all what's integrated into software or lots of different kinds of software to deliver a commerce experience. And that brings us to where we are today. I mean, over 200,000 customers, over 200 billion a year in payment volume across our rails. We've grown revenue every year over year for 23 consecutive years since the basement days. And now we're expanding internationally, which is pretty exciting.
And you guys are global, like you said. You guys did a recent acquisition of a company called Finaro, correct?
Yeah, so we announced Finaro in March of 21. March of 22. It's a bank. It's a payment platform and it's a bank. So it's got a lot of regulatory approvals you have to go through in Europe. So that's set to close in the first quarter. But we also acquired a European payment service provider, or PSP, and that's basically like a technology layer that lives in front of the bank. And that's what gives you kind of that Stripe-like integration capabilities, fraud, BI, recurring billing. It's like a key tech enabler. So as of that acquisition, which was just 2 months ago, we are officially international after 23 plus years. So that was pretty exciting.
Congrats. So you brought up the name Stripe. So I got an email alert from you guys a couple of days ago that you launched something that reminds me of Stripe, where it's going to be easy for developers or website owners to embed forms to start collecting payments on websites. Are you guys kind of going after Stripe?
I think we're just coming at it from a completely different direction. I mean, Stripe is hands down one of the best payments companies in the world. Adyen is like one of the best payment companies in the world. So we certainly aspire to be like some of these giants someday. What makes Shift4 special and has made it special for 23 years is our kind of dominance in card present. So like in-venue transactions, a third of all restaurants, 40% of hotels, stadiums, theme parks. But now we are kind of diversifying into this card not present world. And that's where you have e-commerce and mobile applications, mobile gaming. And the thing is, what made our platform really nice to integrate into from a card present world isn't applicable for e-commerce. Like there's no physical devices and device encryption and debit encryption keys. So basically, like when we do business with some of these, more modern, like take Time Magazine, for example, was a win we announced like 2 months ago. They would look at our integration process and say, wow, this is like way too complicated and time consuming for an e-commerce subscription business. But a hotel would look at it and say it's amazing. So we had to do something to kind of bring in, again, more of that Stripe-like integration capabilities into the organization for all the new verticals we're moving into. And that's what this acquisition in Europe represents.
5 or 6 months ago, now just in full disclosure, I am a Shift4 shareholder. So I get all the email alerts from investor relations, and there was a lot of them going out in the springtime about all of these stadium wins, SoFi Stadium, and I think the Jacksonville Jaguars and a whole bunch of others. So, I mean, I assume it's a very competitive process to get those massive stadium contracts. So what really separates you guys from the competition?
It's really not that hard. Because just to give you an example, when we move into a new vertical, we kind of put our feet in the water, get a sense of the temperature, and then we have to decide, how do you want to play in the space? Do you want to build a product to win in the space? Do you want to acquire a product, or do you want to partner with everybody? And you got to be very careful, because if you make the wrong pick, you wind up alienating all the other software companies that live in that vertical. So in 2020, time of our IPO, we had one stadium. It was Allegiant Stadium, Raider Stadium, basically in Vegas. And we partnered with a software company in that space. And then after we put our toe in the water and we kind of assessed the landscape, we were like, well, there's only 4 companies that serve all of these stadiums. 2 are really old dinosaurs. And then 1 is like a really mismanaged, cash burning kind of grow at all costs business. And then the other was this company called VenueNext. And it was small and it was scrappy and it was winning without all of the resources like a Shift4 can bring to the table. So we acquired them, pivoted their revenue model towards payments. And last year we had like 75 stadiums. This year we have 120 plus.
Wow.
And it really all starts with, does the stadium want to move to mobile? Do they want to make it so the fan can order a burger and a beer and have it delivered to the seats? Do you want to wager in that application? Do you want to buy your merchandise in that app, your VIP tickets and such? VenueNext is the only platform that can do that. So we took what was already a winner and just like supercharged it. And now, I mean, I don't think it would be less than like a handful of our stadium wins were actually RFPs. Most, we just put a competitive bid in and we just win.
Wow. Okay. Now, in terms of what's the revenue model off of something like that? Do you guys charge the stadium a monthly fee, or do you just take a percentage of revenues?
It's both. So most of the verticals we're in, we capture some sort of a SaaS subscription fee for the software that kind of enables that commerce experience. And then we prefer to monetize through payments. I mean, that is the majority of where our revenues are achieved is through payments. So if you take like Notre Dame, Ohio State, Wisconsin, I mean, any of the kind of recent, big wins, they are paying a subscription fee for use of our mobile app technology and our point of sale systems that are in the restaurants or the concession stands. And then we're capturing spread or take rate on every transaction that happens through the application.
Cool. Now, when it comes to reporting earnings, I mean, some companies put out a 1 or 2 page press release. Some put out a 5 or 6 slide presentation. You guys put out like a 60 slide presentation. So it's a lot to go through. There's a lot of details in there, but I mean, it really does give a nice overview of the company. So, you're starting to see slides called sexy tech, right? So maybe talk to us about what sexy tech means for you guys and what are some of the companies that are now grouped in there?
Yeah, I mean, payments is confusing for a lot of investors, and there's a lot more public payments names now than there were at the time of our IPO in kind of June 2020. So it means their attention is kind of split across a bigger field of companies. And, it's not, unless something is like very obvious for them on why a company differentiates and wins, they can easily be discarded. And our story at the time of the IPO was, hey, this is like nearly a pure play payments company within the restaurant space. They got a third share. They're going to be this awesome reopening play, and that's it. And then before you know it, we wind up with, like 40% share in the hotel industry, 10% using our end-to-end solution, and stadiums, nonprofits. Like it starts to become like confusing because they're seeing that we're winning and that we're entering these new verticals, but they don't necessarily know why. And then sometimes, you can wind up getting thrown out unnecessarily, unreasonably discarded.
Right.
So that's kind of why we're going a little bit deeper with the amount of information that we're sharing. Maybe it's to a detriment at times because people
I don't think it's bad. Simple, I appreciate it. I mean, like you said, I think it does help differentiate you. And, obviously you guys you're very focused on certain verticals. So it's nice to know who are the clients in those verticals that, their logos, end up on the slide and, the Harrah's. And I mean, like you said, I mean, pretty much the entire Vegas Strip at this point.
Yeah. So, I mean, and sexy tech was just one of them. And we just kind of lumped in together there things that were, definitely a little bit different. And we have, 1 or 2 really strategic customers in that space, which is pretty key to our international expansion strategy. But we have like Fanatics and Time, and they're awesome. Like these are companies when, for like 80% of our existence, we were supporting, kind of the restaurants on the corner, which is awesome because they, like we're really good at it. To be able to power theme parks and stadiums and some of these like really amazing businesses. It's awesome. It's just a nice evolution of the business. And
2 of the companies that are in sexy tech, and I'll mention them, are SpaceX and Starlink, right?
We have like a number of really awesome customers now. So I think we're getting to the size and profile. Like we're going to try and we'll put slides up in a deck and then try not to refer to them again in the future.
One of the companies that you guys did acquire earlier this year was in the crypto space to help nonprofits raise money sort of from the crypto industry. I mean, obviously, this is sort of a tough week for crypto. Any regrets on buying the company, or you're still bullish long term? I mean, it did seem like a smart acquisition at the time. And, like every other new industry, you go through growing pains. So.
Yeah, no, I think it was a great acquisition. No regrets at all. I mean, if you look at the deal, it was almost almost all the consideration was structured in the form of an earnout because we were very aware that a crypto winner could be on the horizon. But let's talk about what the deal does give us. So a year ago, we announced our entry into the nonprofit vertical, which is a $450 billion payment opportunity. So that's huge. Yeah. And it's completely underserved right now and neglected. These nonprofits are paying way too much, dealing with dozens of different software companies, which they kind of have to. I mean, if somebody wants to donate money through YouTube streaming or playing Fortnite, they got to take those funds. But now they have a mess of software. So we're kind of in a really unique position to help. We have a signature customer in St. Jude and a real technical right to win in the vertical. How do you build on that? And I'll tell you, nonprofits want to take crypto donations. They don't want to turn anything down. Nonprofits will take a broken down car, right? So we bought the Giving Block, where we structured the majority of the consideration to an earnout. And with the way things are going, we'll have to see in the fourth quarter. But we already kind of took back some of that credit in terms of just an accounting revaluation last quarter, that the achievability of the earnout has realistically gone down. But what has happened is all the KPIs within that acquisition have gone up. The number of nonprofits that have signed up continue to go up, more than doubled since last year. Donation volume is still going up. And what it has done is given us a greater foot in the door with every one of the best nonprofits in the world. They're all our customers now, to talk about traditional card-based donation volume, to get at that 450 billion volume opportunity. So I think it was a really smart acquisition. There's tons of talent there. Crypto will come back at some point for sure, and it will prove out to be a good deal.
So back in 2012, when I left Wall Street, I did a bunch of startups, and one of them was actually in the nonprofit giving space. And I didn't realize how big it was until I got into it, which is what got me excited. It is large. I mean, there's, I think, 1.5 million nonprofits out there. And like you said, around $450 billion a year that goes in, that gets funneled into those nonprofits. In terms of, so you guys already reported Q3 earnings. I thought they were phenomenal. Organic growth somewhere in the mid 40s, 40% range, which is awesome. Obviously it's a testament to execution of the team and the verticals that you serve. You also gave some, let's call it light or rough guidance for, was it 2024? You guys think you can get to about 3.5 billion in gross revenues, which I think it'd be about 75% revenue growth over, after this year. So, assuming you guys hit about 2 billion this year, you grow another 75% over the next 2 years after that. But I think the number that really stood out to me was free cash flow. A lot of the fintechs that are out there right now that have come public in the last couple of years are still in that sort of like growth at all cost mode, still losing a lot of money. You guys are very profitable. You increased your free cash flow guidance for this year from 100 million to 130 million. So, is that something that you guys have really put a focus on, is growing, but being profitable at the same time?
I think that's literally what we've done since we founded the business. So, I never had any outside capital until 2014, and the business was started in the late 90s. I've lived through .com, Great Recession, good times, bad times. And for throughout that entire stretch, like, you want to grow, you want to do acquisitions, you want to expand new verticals, you do it out of your own cash flows. Look, 2021 never clicked for us. We're definitely not a product of the generation where it's grow at all costs and we'll figure out margin later. Like 2021, I was like, we can't buy anything right now. Like these valuations are insane. What we're going to do is we're going to raise a ton of cheap cash. So we picked up, 1.2 billion of convertible bonds that have a 0% coupon. It's absolutely free money. You give the money back 5 years later with no interest. And we spent none of it. And now this year, for sure, now that, multiples have come down, a lot of the excess cash is being sucked out of the system. We're picking up awesome assets like we've done throughout our history, where we can unlock a ton of value, create a lot of value for our shareholders. So this has always been who we are. I said at the beginning of the year, in beginning of 2022, when things were looking a little bit, not great out there, I was like, look, as strange as it sounds, this environment is much more familiar to me and my management team than last year. And we know exactly what to do. We're going to prioritize our resources on real needle movers, and make sure that we are well positioned for any uncertain times ahead. I think that was reflected in the second quarter. It sure as hell was reflected in the third quarter.
You guys think you'll do more M&A over the next 12 months?
Oh, for sure. We want to get to, for as many payments companies as people are familiar with, there are really only two that are true global commerce providers. The history of Visa and MasterCard is they were a nonprofit association of banks, and they intentionally left autonomy all over the world to their various banks. So when you have a massive customer, a hypothetical Netflix, they in the past had to do business with 100 different banks around the world, and it was very clunky, time consuming. It was costly. Two amazing organizations out there have created a pretty impressive global commerce platform. We endeavor to be the third in that regard. And now, with a pullback, with uncertain times ahead, and sitting on, a lot of cash, delevering very quickly, we're going to absolutely pick up assets in Central and South America, Africa, Asia Pacific, and stitch together, a pretty impressive platform and come from positions of strength in the card present world. I find it incredibly exciting. So
I was just going to ask you if you'd be more likely to do deals outside the US than inside the US. And it sounds like you see bigger opportunities out there, and the valuations have probably come down even more overseas.
Oh, totally. You've got organizations, it's the biggest VC names out there that have outright pulled out of entire continents. So companies that thought they were going to be on the verge of these, multi-billion-dollar IPOs, are left now without a source of funding. So, I mean, the opportunities are pretty incredible. We have a pretty good pipeline, amazing strategy team, and we're going to build on it. So yeah, I would expect like a lot of really creative, value creating acquisitions in the year ahead.
Do you guys do any early stage venture investing off of your balance sheet?
We do. So we've done 3, 2, like I would say very, small deals in the, sub $2 million range. Generally they have to be, a kind of what we see as complementary to our long-term payment strategy. So some application or software that's making a commerce experience better. It doesn't really matter the vertical. And then we want to hitch a ride on the payments for the long term. There was a much bigger company that we, Shift4 put an investment in that, is obviously very strategic as well. So
I think I know the name, but I won't say it. Any other industries that you're focused on or have your eye on right now? I mean, obviously, you've crushed it in hospitality, which is restaurants, hotels, travel. You got a bunch of the airlines, the casinos, the stadiums. What's up next?
I think like we're growing at a wicked fast rate in all our current verticals. I mean, our year-over-year volume growth was like 53% for the third quarter. And we've been generally at that pace for a long time on some big numbers. So all of our current verticals are awesome. We're going to look for ways to kind of accelerate growth in those verticals. If I had to pick ones that I'm, more excited than the others, gaming is kind of interesting because it was illegal for so long. So it was like this giant underground industry if you wanted to make a sports bet. And now, states looking for tax revenue, plus like just kind of the right thing to do, are regulating. And now you can make a wager on a game in most states in the country. And we've been growing pretty fast in that vertical. It's huge globally, like shocking, like how big it is in certain markets. So pretty excited about that. Very excited about nonprofits. And then, hotels and restaurants, we're just so advantaged in that space. I think we're going to keep doing well, especially as we kind of take that magic into international markets.
Cool. Just real quick, tell us about yourself. I know you are a space junkie and I believe you've become an astronaut. Have you been to space yet?
I have. So I went to orbit for 3 days. I led the Inspiration4 mission, which launched in September 15th. 21 SpaceX Falcon 9 Dragon spacecraft. So that was pretty awesome. And we have a number of other really cool space endeavors ahead with SpaceX. Polaris Dawn is another mission that'll launch early next year. It'll go highest, altitude anyone's been since we last walked on the moon, which is pretty cool. A spacewalk, all meant to kind of develop new technology that furthers, humankind's long-term interest in spaceflight. And when I'm not up in orbit, I'm pretty active pilot here on Earth. So
awesome. Well, Jared, thank you so much, man. Anything else that we skipped over that you wanted to have a chance to talk about?
No, I really appreciate the interest. Thanks for reaching out on that.
You got it. Well, thank you very much for everything you do, and congrats to your team on another great quarter, and glad to be a shareholder.
No, thank you very much, John. Appreciate it.
Bye, Jared. Talk to you soon.